Hey everybody, welcome to the Thursday Financial Thing live stream. Glad you're here with me. I'm going to try to get through the stream rather quickly this evening because I need to make a run to the airport to pick up a family member who's flown all the way over from the UK to come visit little old me and little old Harley. So we do have quite a bit to get to this evening. A couple of really interesting emails that came in over the last few weeks that I somehow missed, but I thought it'd be good to go through those. Talk a little bit about crowd property. Couple of dates to remember. May, I believe 9th. We got Natalie Weeks here from Cufflink Live, and it's going to be May 16th, confirmed with Mike Bristow from Crowd Property here on May 16th. So put those dates in your calendar for live guests. Yeah, we're going to get right into it. Hi, everybody. I'm not going to go through the hellos tonight, but if you can give me a thumbs up, I appreciate it. And quick shout out, of course, to a sponsor of our stream and the Financial Thing YouTube channel and the Harley Cam, to Cufflink. Thank you to Cufflink for being a generous sponsor of the show. Now you can earn up to, and I think it's over more than this at the moment because of the promotional rates, but 9.83% is what I have here, but it is a little bit more now. I think on the 1 year you can get over 10 now, 10% on the auto lend, but way over now. £300 million of property-backed UK investments made since 2016. Zero investor losses to date. Of course, that may not always be like that, but right now that is the case. Capital is at risk. Remember, your capital is at risk, people. This is investing in peer-to-peer lending. It's not protected by the FSCS. Don't invest unless you're prepared to lose money, because one day you will. And not necessarily through Cufflink, but through some form of investing. And remember, these interest rates can change as interest rates change. You can sign up at join.cufflink.com/financial-thing. The link is in the description below. Thanks again to Cufflink for sponsoring the stream. Quick. Let's just get straight into it. I wanted to have a quick look into LoanPad and see how their statistics are looking. It's been a while. Now up to 17 lending partners now. Look at the size of LoanPad's amount of loans they have now, north of £90 million. Total loan value of £173.4 million with a security value of $217,227,000, which is a still pretty low loan to value of just 41%, with 209 loans now in their portfolio, 17 lending partners, interest coverage funds still not being used, and liquidity still as good as when they first launched. I think now back in 2019, 1 day to sell estimated, 1 day estimated time to invest. I have not seen that £10 minimum come yet, down as we were hoping it would, but still that software update hasn't occurred yet, but I'm hoping it will do soon. And they've had 639 loans now total on LoanPad, and 430 loans have been repaid, which is £155,185,000 of loan repaid. So LoanPad continuing just to slow and steady wins the race with 17 lending partners. Also last week talked about LendInvest, and I was a little concerned about how many of my total portfolio was in this red zone here, in arrears, out of breach, or enforcement. So that is continuing to be 8 now, loans out of 20, so 40%. I did get a Facebook comment. Somebody said, was there a secondary loan market to be able to exit loans in LendInvest? There is not. Pretty much all you can do is go into your summary and then adjust your reinvestment in your portfolio. So if you feel a little jittery about LendInvest because of these arrear amounts, then just turn off your auto invest and collect the interest and capital that comes in, and don't reinvest it until they sort out these loans which are in arrears. Disappointing that to see, some of these loans are supposed to have been repaid here in 2023. I know some of them are going up for sale, like this one here, Hook Style Lane in Farnham. But then you get these updates which says, unfortunately, the sale of the asset is not yet to be finalized, including continued delays in communication with the local council. So things do happen when it comes to property, but it's really good to keep an eye out. But yes, there is no secondary market in LendInvest. Remember, it's not strictly peer-to-peer lending, as you are lending money to LendInvest, but hopefully these out of breach and enforcement loans will be taken care of. To the news, RoboCash. This was a report that they put out saying the peer-to-peer lending market is poised to rival S&P 500 in returns. Peer-to-peer lending is predicted to offer the most attractive real returns among fixed income instruments by the end of 2024, and may, notice the word may, overtake the S&P 500, according to analysts at RoboCash. The Croatian-based peer-to-peer lending platform said that people invested in peer-to-peer in late 2023 or early 2024 will earn approximately 6.7% per annum net of inflation in US dollars at the end of the year. This value is dozens of times higher than example bonds or cash deposits, which of course bonds have not been performing very well over the last few years. The lender highlighted that the European Central Bank has kept deposit and bond rates flat at 4.5% for 7 months and is likely to start lowering it towards the end of the year. If the predictions come true, peer-to-peer investments will overtake the S&P 500 with dividends, which experts estimate will give a 6.1% return. They also say that commodities, they believe, will way outperform when adjusted for EU inflation, peer-to-peer lending, and the S&P 500. I think, estimating how peer-to-peer in general will perform against the S&P 500 is throwing a dart with your eyes closed at a tiny postage stamp-sized dartboard. You just don't know at the end of the day. Nobody really knows. The S&P has been on this bipolar up and down for the last few months. We've seen it over the last few days, this retraction in prices of the stocks and the S&P 500. But obviously, peer-to-peer does tend to operate more like a fixed income product, even though there are certain risks that come along with peer-to-peer lending. I think my average returns over the companies that have performed has been around 6.5%, maybe 6.2%. But I think over the last 2 or 3 years, the S&P 500 has performed way above that. So, but I also think we're in for a rocky 2024. You can see it now with what's going on in the world. But it's an interesting article. It says here the RoboCash platform itself, which is peer-to-peer lending, is currently advertising target returns of 11.8% per year. So it all depends on what your risk tolerance is, right, when it comes to peer-to-peer. If you're willing to take a stab at some of the European peer-to-peer lending platforms, you can certainly get those double-digit returns, but just know that your risk is probably quite elevated. Invest and Fund, one of our peer-to-peer lending platforms here in the UK, says that peer-to-peer platforms play a key role in affordable housing conundrum. Invest and Fund believes peer-to-peer lending platforms like itself can play a vital role in what it calls a brave new world of affordable housing financing. It believes a recalculation of affordability may be needed to solve the housing conundrum in the UK. Data from 2022 and 23 shows that more than 63,000 affordable homes were delivered in England, representing a 7% increase year on year. Once you fast forward to today, in 2024, the average house price in the southeast of England stands at £373,000, which is out of the affordable scope of most people, and that's certainly not what they would consider an affordable housing. Peer-to-peer lending can certainly help when it comes to that, because these platforms can offer financing and loans to builders who are trying to enter the affordable housing space. And I just don't think that these builders are going to be able to go to a high street bank and get that type of financing. It's very, 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 very tricky to get high street bank financing. I've experienced it myself. Working on a deal to get bank financing has taken absolutely better close, I would say, to a year, and just stupid delays. And certainly if you're a developer trying to acquire competitive pieces of property, trying to finance things through the bank is very, very difficult, it's not really cost effective, and it takes a long time-wise. So peer-to-peer lending is exactly trying to solve these problems. Crowd Property launches a new feature. This was very, very interesting. I'm going to zoom in to show you this. They have launched a feature called Instant Decision in Principle. This is a new feature set up to significantly speed up property development financing. The company's latest technical development will be officially released at the Property Investor Show at London's Excel Centre tomorrow. That's April 19th and 20th. And what this is basically doing is going to use data to make quick decisions on financing that they then will be able to offer on the platform to you and I. It says in this release that historically property developers have had to wait and receive a decision in principle, but with Crowd Property's new IDIP feature, they can get an immediate response underpinned by a decade's worth of financial applications data, more than 15,000 funding applications, and over £15 billion in funding requests. One of the Crowd Property folks said, "The arrival of our IDIP proposition is a game changer, providing property developers with the all-important responses they need when they need them. Property transactions can be time sensitive," exactly what we were just talking about with the high street bank. "So every minute that can be saved matters, particularly when you're competing for a site or negotiating with a vendor." During a recent pilot exercise, numerous property developers submitted multiple applications due to the exceptionally speedy response. "We're focused on accelerating funding provision, enhancing transparency, and fostering long-lasting relationships with our client. Our new IDIP leverages our extensive wealth of data, insight, and technological expertise, and the benefits for developers are a big stride forward within the overall property development finance market." Crowd Property's IDIPs are powered by Building Underwriting Intelligent Lending Decisions, aka BUILD, an in-house automated deal appraisal system that taps into the bank of data and analytics collated by the company over the last 10 years. BUILD offers an unbiased and accurate appraisal of project risk, enabling us to swiftly provide indicative pricing and progress funding applications with certainty from the outset. So Crowd Property obviously is targeting on providing quicker decisions for people applying for loans, which I think is really a first mover advantage. I'm surprised other companies haven't used AI, things like that. I know they're using open banking to try to get these decisions to be a lot faster. And when these peer-to-peer lending companies can provide fast decisions, they're going to have a considerable advantage over the high street banks that take absolutely months or even sometimes years to make financing decisions. The big question here is, does the risk get assessed properly? Because, we all know with peer-to-peer lending, the big problem is assessing risk and making sure that they take on loans that don't run into problems, and some of that takes some time to look over the data. So whether this system will be able to do that really remains to be seen. But on May 16th, when Mike from Crowd Property comes here live, we can ask him about this IDIP system and see maybe that this system will actually cut down on the amount of loans that are going into trouble, because maybe they have some better data analytics that they can use to cut down on the risk. We shall see. We got a Able Rate update email saying a letter has been added as a document to each outstanding loan. The letter details the outcome of the recent decisions circulated in respect to the joint administrator's proposal. So this is kind of a summary of what we looked at in the proposal, which said, in short, decisions 1 were approved. That's the joint administrator's proposal to be approved. Number 2, a creditors committee will not be established. Now that is a formal creditors committee, and the basis of a joint administrator's fees and the approval of the pre-administration costs. So number 3 and 4, so those fees were rejected. And number 4, the approval of the pre-administration costs were also rejected, which that's pretty cool. It also says, despite no formal creditors committee being created, the joint administrators still intend to create an informal committee of loan investors. The role of the informal committee will be like that of a creditors committee. So that's really good. We want to make sure that lenders are represented. So if you want to nominate yourself to be on that committee, I know some of you out there are investors of Able Rate loans. You can email AbleRate, ABLRATE, at quantuma.com. Nomination should be received by May 3rd. So you've got about 2.5 weeks to go ahead and get those nominations in. Make sure you go ahead and do that. It's going to consist of 3 to 5 members. If there are more than 5 nominations, the joint administrators will request a short candidate statement from each nominee, which will be circulated, and all loan investors will be able to vote on the members of the committee. So, yeah, go ahead, and if you are wanting to be on that committee, which I would suggest anybody who has money invested in Able Rate, you want to be involved and represent you and other investors, go ahead and join that informal investor committee. Able Rate at quantuma.com. If you're an Able Rate investor, you would have gotten that email also. Really interesting report that was sent out by Plend. It's called the Financial Inclusion Report of 2024. And Plend, of course, never entered the retail peer-to-peer lending space, but I was really interested to read this. I wanted to find out what is really going on in the UK with the financial system. We see a lot of mixed things, right? We've got this inflation problem. Some people seem to be in a bit of a financial bubble, like the wealthy are getting wealthier and the middle class are being squeezed, and the lower income obviously struggling with the high cost of living and inflation. But this report is actually super interesting, and I think it gives us a picture of what we can expect with going, particularly things like interest rates, and maybe a look into what the stock market's going to do in the next 6 months to a year. So I'm just going to go through this a little bit and show you some of the things that I found. Now, this research report was conducted in January of 2024, and it draws upon 3 data sets: 4,000 nationally represented UK adults, that's a pretty big pool of people, 500 Black, Asian, and minority ethnic adults, and 26,000 planned customer applications and lending performance data. You can see a couple of these numbers here. 28% of people feel locked out of the financial system, rising to 40% for Black, Asian, and minority ethnics. 90% of the population felt impacted by the cost of living crisis in some way in 2023. 44% of UK adults are financially vulnerable. 34% of vulnerable adults believe that their bank would not be there for them in emergency. That's very, very true. They won't. Maybe they'll give you an overdraft if you're lucky, but they'll charge the hell out of you for it. 65% of people struggle to repay loans. This rises to 72% for women. 41% of people said that their financial situation would improve if they could access a generally low interest rate loan, up from 39% last year. 42% of people who applied for a loan in the last 24 months have been declined. That's almost half. Now, we get into some of the writings in this document. In the UK, 44% of UK adults are financially vulnerable. 65% are in a worse financial position than they were last year. So if you look at where this data is coming from, you got the 4,000 UK adults. That's good. Now, the 26,000 planned applications are going to be in sort of this niche. Yes, I see. Sorry about that. I lost you there. I'm back now. 81% of the UK currently have some form of credit, jumping from 79%. Almost half, 46% of all those with a credit product, took out credit specifically to keep up with the financial impacts of the cost of living crisis. That's a 4% increase from last year. So a lot of people taking out loans. They're going to places like friends and family, and also those short-term lending companies who give people paycheck loans and whatnot, pretty high interest rates. Also going for consumer loans. Financial services are harder to access. 42% of people who applied for the loans in the last 24 months were rejected. I have something to say too about that, and what exactly are we doing to prevent these type of issues. Plan statistics bring home the reality of the cost of living crisis. 90% of those surveys felt impacted by the cost of living crisis in 2023, only marginally down from the previous year. Access to fair credit is a key part of being able to live a reasonable life in Britain in 2024. People are struggling to afford credit. Look at this. Over the last 12 months, the average APR, annual percentage rate on loans, decreased marginally from 21.4% to 20.3%. Imagine that. 2022, that rate was 16.3%. So people who are loading up these credit cards are paying around 20.3% in interest a year. And then it says 65% of loan holders have struggled at points to repay their balances within the last 12 months. Well, of course. I mean, you're borrowing £100, you're paying £20 plus an interest. Of course, you're going to struggle as that compounds when people pay minimum payments, as the credit card companies want you to do, and they struggle to pay back the loans. This is a quote from the senior research fellow at the University of Bristol, Sarah Davies. PFRC's 9th Financial Fairness Tracker found over 40% of UK households are struggling or in serious difficulties, echoing Plan's findings. Consequently, many seek credit for financial management, yet the mainstream credit market fails to meet this demand. This is a story of one of Plan's customers. Michael, 55, had resorted to using multiple credit cards to cover his regular expenses. That's really sad. 55-year-old gentleman doing that. 72% of women have found it a struggle at times to pay off their debt, compared to 61% of men. 29% of women have used BNPL, which is buy now, pay later, compared to 20% of men. So they go into these, I call them loan sharky type of businesses that, buy now, pay later, meaning they're buying things probably that they can't afford. When we get into ethnic, things look really bad. A staggering 91% of black and Asian and minority ethnic adults feel impacted in some way by the cost of living crisis, with just over 26% saying it had a major impact on them. This sector has borrowed quite extensively, 61% of them having to borrow money to cover their bills because of the impact of cost of living. And then we have the impacts of location. The Northwest has been most severely impacted, with 91% of residents experiencing impact from the increased cost of living, followed by London and the Northeast. The Northwest region experienced the highest percentage of loan declines, 50%. So 50% are getting declined when they're trying to get credit. And it just keeps on going on and on. It talks about young people, how they're experiencing problems with their finances, and people with disabilities. 48% have suffered negative mental or physical health as a result of the cost of living crisis. I mean, having a strain on your finances really can cause some impact on your mental health. Look at this. Subprime borrowers are currently facing an average interest rate of 33% a year. That's crazy. So that means people with low incomes are borrowing money, and they're borrowing it at really, really high interest rates, which is putting them even into worse financial difficulties. 1 in 8 people would not be able to cover any of £1,000 unexpected expense without turning to borrowing. 42% of loan shark users belong to low-income demographics. 10% of people have considered using a loan shark in the last 12 months. Buy now, pay later. While the percentage of UK adults using buy now, pay later is 24%, that remains consistent with last year. So really, really interesting report, but what they don't really address here is the causes of why this is happening, what people's relation to money is. What they don't talk about is, what are these people doing to really improve their financial situation? Do these people have expensive car loans? Are they doing a budget every month? Are they being smart with their money? I mean, there's small things that you can do to decrease expenses, like, shop your insurance every year and see if you can reduce your mobile phone bill and your internet bill. Stop wasting money on coffee every day. But it doesn't address any of that. And then it really doesn't address the real root of the problem, which I believe is the lack of financial education that these people really experience. Most people have no idea about finances. I mean, you guys who watch the stream are probably a lot more informed about financial education and decision making than nearly everybody out there, especially in the UK. And this again goes back to a problem that finances are not taught in the school system. And when I was going to school, I had a really weird relationship with money, because I grew up in a pretty stable, medium class family that I don't think we ever wanted for anything. I mean, we weren't rich by any means, but I never had to really think about money. And that was actually a real detriment, because when I went out on my own in life, I'd never really been taught about money, and nothing in school was being taught. And what's happening is just this continuous problem where people are coming out of the school system, becoming young adults, not learning about money, not learning about saving, not learning about investing, taking on too much credit, being offered credit cards that have super high interest rates. And then it just becomes this disastrous circle of debt where people take out credit cards and it just keeps compounding and getting higher and higher balance. I mean, one of my closest friends said he's about to pay off his student loan. This guy is 50 years old, and he graduated in 1998 or 1996. He's just paying it off, his student loan. That's ridiculous, So this relationship with money that people are experiencing goes back to a lack of financial education. And these studies, they don't talk about how this problem really gets solved. The problem is not giving people access to more credit, which is what this report is saying. We want to give people access to more credit. I take the other side of things, is that we need to educate people so they don't need credit in the first place, right? There are ways to stay out of debt, 100%. Like, don't spend more than you make. If you need to make more money, take a second job. Sell things that you can to make extra money. Invest it. Pay yourself first. But none of these things are taught. A lot of people don't know how to invest. And I know because I get these emails every week. What do I do with my money? Where do I put this? What should I do? I've never been taught. And these reports really need to start addressing not only, I mean, Plan, God bless them. I like Plan and what they're doing, but they're also saying we want to give people access to more credit. Is that really a solution to this problem? I don't think so. You let me know what you think. Anyway, moving on. I'm going to hit the mailbag. Hi from this subject here on this email really got me nervous when I first read it. It said, hi from Trevor the Lurker. Because there's so many scammers out there now, and I get some weird emails sometimes, but this guy turned out to be just a normal person. He said, greetings, Lawrence. I started investing in P2P loans about 2 years ago. This was a email from February this year. I started investing in P2P 2 years ago. I've been pretty satisfied so far. I also started investing, buying index trackers a year and a half ago, which has gone well. So far, finger crossed. I think he's supposed to put a bracket in there. I came into some money recently, mid 5 figures. I feel torn on what to do with this money, as I noticed the stock market is really volatile. Things seem unstable in the world. This money is not insignificant to me, so I'm feeling a bit jittery. Do you have any words of wisdom on how I can come by investing for years and what I should do with this money? I don't really understand what that means, but I think he's just saying, what should I do with this money? Thanks, mate. Trevor, longtime lurker of the live stream. Well, Trevor the lurker, I've shown this chart before. I think it's really interesting. This is called the visualization of 150 years of S&P 500 returns. And it says, despite cautious analyst forecasts of 5 to 10% returns for the S&P 500 in 2023, 2023 defied expectations and returned 24.2%. So analysts were saying we were going to get 5 to 10% increase in the S&P in 2023. We actually ended up getting 24.2%. And you can look at these interesting numbers right here, which shows you years that we've had minus 50% drawdowns in the S&P up to 50% increases. So you can see here 1931 was that terrible year of the financial crash of the USA. And then on 1933, just 2 years later, we saw a 40 to 50% increase. But you can see most of the blocks of years go here in this 10 to 20% range. Saying, where will 2024 end up? Who knows? We saw 2023 ending up here on this 20 to 30% range, but the majority of what we see here is in the green of these years, in 0 to 30%, and then we have less of these blocks in the 0 to minus 20%. So history would show that over the years and over the decades, that's what you can likely expect. 2024 might be a little different because of the instability of what's going on in the world, but if you zoom out, they say when in doubt, zoom out. So you look at the S&P, generally right now we're up here. So we've reached that all-time high and had this pullback, which is still higher than the previous all-time high of 47.69. So you can see the drop back. But if we zoom out, this is what we see. Again, no guarantees, Trevor. I hope you're watching this. You say you're a long-time looker of the stream, so hopefully you'll see this. But if we zoom out, you can see a trajectory of this since the late 80s right here. Of course, we've had some pretty nasty drop downs, but that's just part of the deal. So I would say, the best thing is just to take your money and, I don't know how old you are, but I'm presuming you're not in a retirement age where you don't need that money anytime soon. If you could leave it for 5+ years, just pop it in an index tracker and sit back and don't make any silly moves. Don't try to stock pick like I've done. I'll show you the Trading 212 portfolio so you can see how that's doing, and that's the reason why you shouldn't stock pick. But hopefully that will give you a little bit more confidence. And again, if you have a pretty big chunk of money, you could just put it in over a period of a few months to hit some of the highs and lows that the S&P or the trackers might experience. We do have a U.S. general election in November. We've got a tentative situation in the Middle East, plus inflation does not seem to be under control in the U.S. or the U.K., which might affect these stock market volatility. Another email from January of 2024. Hey, Al. I've been reading your website since 2016. Keep up the good work. Thank you very much. I know it isn't easy what you do, so thank you. Why does everybody have typos? So many typing mistakes today. I've been looking into picking out individual stocks for 6 months. I know, probably not a good idea. Yes, it's definitely not a good idea. It says Mr. Brokerage Account shows a list of recommendations. I don't know what Mr. Brokerage Account is. Maybe that's a website. Shows a list of recommendations for individual stocks from financial analysts. What do you think about this and the types of research they provide? Can they be trusted? Cheers, Jock. Well, Jock, I would tell you that no, none of those recommendations can be trusted. Those financial analysts are all over the place. I'll show you an example. This is, I just picked a random stock. This is Carvana, which is a United States car company that basically they have these cylinders, these glass cylinders with the cars inside of them, and you could just go up and tap the screen and literally buy a car, and the thing will rotate and the car will be delivered to you. It's the silliest of things. But I'll just give you an example of analysts here on February 23rd of 2024. The Morgan Stanley people were underweight, which is basically sell in the red. You can see this was $69. Well, the stock proceeded to go up to $80 over the next month. So if you'd have sold your stock based on that analyst of Morgan Stanley, who people think are good, then you would have lost $11 a share in upside. Also, look at the Tesla analyst. This was today. I pulled this. You got Deutsche Bank saying $123 price target. You've got Morgan Stanley saying a $310. And then a guy down here, Gordon Johnson, saying $22. So, I mean, these analysts are just all over the place. It's crazy, right? Look at this. Analyst average return for Tesla minus 55%. So do they know anything more than us? Probably. They have data and technical analysis. Does that mean that they can predict what the price is going to do on an individual stock? Absolutely not. I think you have probably just as good a chance of letting a rabbit step on pieces of paper with different stocks, see which one the rabbit steps on first, and getting it right as you do following these analysts. Some of them will get it right, of course. They say even a blind squirrel finds a nut sometimes. But generally, you're going to have a difficult time if you follow these analysts and copy what they do. I'll give you a couple of examples right now. And somebody that I actually respect and do follow on Twitter who put out a tweet. His name is the Chicken Genius. He said, this is November 5th of 2023. I think $40,000 Bitcoin is coming sooner than expected. About a month later, Bitcoin did hit 40,000. And right now, during this tweet, it was at 35,000. But he also suggested buying Rivian back in November when the stock was $16. This is also November 2023. I would consider him very financially sound. Now you can see the Rivian price is $8.85. So that's a 50% drawdown, just going to show again. These guys, this is not an analyst, but he's more of an influencer analyst. He cannot get it right either. If you decide to stock pick jock, you're going to be in for a rough ride. Like I have had some really lucky trading 212 portfolio hits, but I've also had some pretty bad red ones. You can see here, if you want to take a look, jock, 60% down on Green Power, 40% down on Rivian. Creative Realities down 13%. And then we've had some good ones with Coinbase, but Coinbase was up almost 100%. That's come back almost 30% now on Valco. So if you do stock pick, your chances are you're going to have a portfolio that looks similar to this. You'll have some wins, you'll have some losses. And if you calculate that out, jock, over a period of time, you're probably going to do worse than you would have just putting it in an index tracker and letting the index tracker do the work for you, because you are not going to get it right. So the trading 212 portfolio now at 19,346. So that's come back in about £1,000 to where it was just a few weeks ago. I just want to show you a change that I made in the portfolio, and this was not. I mean, it seemed like a good move at the time, but it wasn't particularly good, and I'll show you why. This is the terrors of stock trading. I sold 11 shares on the 16th of April 2 days ago at a fill price of $209, which put us in profit of £731 and 18p, which is good, except right now the Coinbase price has gone back up to $218. So that was a $9 share price change. So that cost just a little bit less than £100 that we could have had of the upside from selling, and now we're sitting in even more cash, unsure what to do. We have some important things happening over the next couple of days when it comes to Bitcoin, so I'm not sure what's going to happen with that price action, but sometimes it's better just to sit on the sidelines and see. I think it's who knows, right? We don't know. Bitcoin is going to halve. This happens every 4 years. So 1 day, 4 hours, we'll see a Bitcoin halving. This is where the block reward. So miners are going to get 3.125 Bitcoins per block instead of what they're getting now, 6.25 Bitcoins per block, meaning Bitcoin becomes more scarce. I don't know what's going to happen to the price of Bitcoin, but if it goes down, then Coinbase will obviously go down too. If it goes up, then Coinbase price is going to go up. So I thought maybe best just to take some of that profit, sit on the sidelines, see what this happens over the halving over the next day and a half, and then decide whether to re-enter that position or not. And then I'll just talk real quick. I thought this was an interesting posting on Twitter that said bonds are terrible investments. If your financial advisor has you holding bonds, fire them immediately. Here's a simple economics lesson. The U.S. has entered a period of high inflation. As a result of inflation, interest rates increase. When interest rates increase, the price of bonds decreases. Investors sell them in search for ways to earn higher returns on their capital. A little bit of misinformation. That's not exactly how the price action works on bonds, but inflation is not going to go down. Government spending is completely out of control to the point where $50,000 US in 2021 is now only worth $38,000 US. Put that into perspective. So over 3 years, we've seen $50,000 in cash deflate to $38,000. And if you don't have a case for things like Bitcoin, you can have a case just based on those two numbers. 24% decrease in the US dollar in 3 years. That means any asset class that hasn't gained 8% a year since 2021 is losing value. Dollar debasement will accelerate over the next decade and bondholders will get destroyed. The national debt is growing. Deficit spending is getting worse every month and year. There's no clear path out. Once the ball gets rolling, there are no brakes. You can see here, this is an iShares 20-year U.S. Treasury bond ETS, which has lost almost 30% of its value in the last 5 years. And two, whether I talk about the U.S. or the U.K., same goes. They work in parallel with each other, the way these interest rates work and how the stock market fluctuates between them. This is a great point. Really, I've always said that bonds are just an insurance policy for equity market corrections, where you could have money in bonds, and then if the market's correct, move the money from the bonds into equities. But the problem is when these bond prices are just losing money so much, and you're down 30% in 5 years just on this bond ETF, it doesn't really hold any beneficial value to being in something like that. Even if the equity market did correct by 30%, you still wouldn't really be winning. So I'm not sure that that case is even valid anymore. Bonds seem to be as volatile as stocks now, and who knows what the real answer is, but I thought that was an interesting post. Also in the news, UK inflation slows by less than expected to 3.2%. That means inflation is not actually dropping, it's just slowing down. It's still increasing. It increased from up 3.2% from the same time last year, but it's still not going down. The Bank of England has an inflation target of 2%. They're never going to get back to 2%. 3% is going to be the new inflation norm. And are we going to have interest rate cuts? I would say questionable. They can't get this inflation under control. They can't cut interest rates. So good for savers, bad for everybody else. Bad for people that are having low income issues and whatnot. Okay, that was it for today. A lot of stuff. If you enjoyed the content, please hit that thumbs up. I know it wasn't a ton of peer-to-peer lending stuff today, but it was kind of a quiet week for peer-to-peer in general. Don't forget, May 9th, Natalie Weeks from Cufflinks. She does collections. She's going to talk about how they enforce collections on loans and properties. And then May 16th, I believe. Let me check my calendar here. Make sure I'm giving the right date. I'll be Mike Bristow from Crowd Property. 16th. So we'll have two guests in May 9th and the 16th. Back hopefully next week. I'm not 100% sure what day I'm going to be here, but we'll see what happens. I'm just going to check your comments very quickly before I get out of here. To run down to the airport. Hi from Bridlington, Peak District, Kenilworth. Alan Brooks is here. John Day, Aki Chap in Accrington. Annabelle Nyron from Spain. Grand Cayman, France. Better late than never, Dave. Hi, Mike Powell. Mic off. Yes, I know my mic was gone. Wakey. I'm sorry about that. I think it's more serious, Dave says, than drinking coffee, talking about people's finances. Well, I mean, it adds up, though, £4 a day. People who some people go, my friend used to go to the coffee shop twice a day. So you're spending about £10 a day on coffee. You do that 20, 30 days a week. Sure adds up. And that's just one part. But yes, I agree with you. Just getting your teeth fixed can cost us a fortune. What about the NHS? They don't do that anymore. I agree. Drip feeding money into the stock market would be good. Ask yourself when Rivian make a profit and pay a dividend. It's probably going to be a while. But I tell you, I go out and see those Rivian Amazon trucks everywhere. So that leads me to just believe that they're going to be making money. Anyway, I got to get out of here. Love to every single one of you. Thank you for being here. I really appreciate it. I will see you next time. Check your emails on the Facebook group to see when the next stream is. And have a wonderful weekend. Myself, Harley, and the Cufflink Cam, we are out of here. Check you next time. Take care.